Bank of England economist Carsten Jung, who joins us. Good morning to you, Carsten.
Good morning, Julia.
Thank you so much for joining us. Well, the meeting that the Monetary Policy Committee had actually took place yesterday. We find out at midday today what decision they took. Pretty much every man and his dog is saying it's going to be a 0.25% rise. Do you think that's the right decision?
I think they should go more slowly. When we last spoke, I was already saying I think interest rates are too high. It's important to say that it will be effective at slowing inflation, but at what cost? And are there other options that we could consider that would be more balanced? You could think of the economy like a big ship, right? So if you want to change course, it moves only very slowly. And that's what we're seeing. The economy is actually slowing already. Inflation is coming down. And the risk is that once it's come down as much as we like, and the economy has slowed down as well, we might actually realize we've done it too much and we're overcorrecting, and then we'll have to, change the rudder around and row back again. And that's really a situation you don't want to be in. So I think they're going too fast.
Many economists and business people and politicians and us ordinary voters who've got quite a lot of common sense have been warning about that if the pressures on inflation are external, then having these internal changes isn't really going to make any difference. We're going to still have inflation while we've got high energy prices and the knock-on effect of the manufacturing costs and the agricultural costs for our food. That is still going to be there, whatever the interest rates do. Meanwhile, you make life harder for people trying to, own a home, businesses. We've got massive loans, a lot of them post-lockdown as well. They're paying higher interest rates. You're dampening the economy just at the time when we should be, as Justin Urquhart, Stewart, economist we spoke to earlier, pointed out, we should be building consumer confidence.
Just to defend the Bank of England a little bit, what they're trying to do is to prevent inflation expectation, so-called, to remain too high. So they're like, if inflation is high for too long, people will just expect it to be higher, and they will demand higher prices, higher profits from it. So they're basically getting the crowbar out to tell people we're gonna prevent this from happening. But what could have complemented their approach is the government doing more on energy price support, for example. Because if the government says, hey, we're gonna help you with energy prices throughout the winter, so there's not going to be another spike, that is also a thing that will help.
That would dampen that down. But again, the government doesn't have any money. They've only got taxpayers' money. You have to tax people more now or tax people more in the future. And with those interest rate rises already we've seen, it's costing more for them to borrow. We spend more servicing our national debt every year than we spend on our schools, for goodness sake.
Well, it's a balancing act, actually. If you use this money to ensure people know inflation is going to be low, that will actually have macroeconomic benefits, which could mean that interest rates won't have to be high as much as they are right now. And, other countries are borrowing more for longer, like the US. They're on course to borrow twice as much in relative terms as the UK in 2 years' time. So, it's
certainly something they can do. I think one of the issues with the Bank of England is that they've got this one target. They literally got one job, which, by the way, they're not very good at, keeping inflation at around 2%. I'm not entirely sure that using that lever of interest rate should be something that should be left to unelected, unaccountable economists at the Bank of England. I think that should be something that should be decided by democratically elected politicians making a decision, being accountable to us voters. Because inflation is a massive issue, but so are also mortgage costs. And again, there are lots of other things people have to spend their money on. And the idea that, we might have to have a recession to dampen inflation. I know inflation really, really hurts the whole of the society. It hurts everyone. Whatever you do, it hurts everyone. But, so do recessions as well.
So I agree with your sentiment. I don't agree with your conclusion. So the central bank independence has, there's lots of research showing that it has helped keep the expectation of inflation low, because people say, there's this big guy in the corner, it's the Bank of England, and he will make sure ultimately that inflation's okay.
But he didn't.
I agree with
he didn't.
Well, but because you have these big shocks where, you can't guarantee that it's always at 2%, but that ultimately will come back to 2%. That's sort of the guarantee. But
wait, hold on a second. The Prime Minister reckons that he wants to, one of his 5 aims is to get inflation halved, so down to 5% by the end of this year. You think we're going to get inflation back down to 2%? When's that happening?
Well, it's forecast to be expected to target in 2024-25.
Well, we know that's not going to happen because there's never been an economic forecast that's been right.
You know, I don't want to defend economic forecasts. It's very
There's
hard.
never been one that's been right.
But here's the thing: Spain is already back to the 2% target.
Okay.
France is also quickly approaching the 2% target. And what they've done is they had the government, not their central bank, the government, do much more by guaranteeing energy prices. In Spain, they said, actually, landlords, for this time that is really hard for all of us, you can't raise rents for more than 2%. You can't raise rents by inflation. The Spain also put in place taxes on businesses that made excessive profits. So they had less incentive to pass prices on. And that was a big part of the story why they're already back to where we want to be.
Okay.
And you know, that's the thing.
Except with a huge amount of government interference and a huge amount of government borrowing, which taxpayers ultimately will have to...
It works.
It works in the short term. Does it again? Does it? The solution now always seems to be the government needs to borrow more or tax more to spend more. The government is the government needs to get more involved. Eventually, the government's going to be paying all of our bills. I'm going to be asking the government to buy me a Pret coffee at this rate. Mind you, you need a mortgage to get a Pret coffee. What are they, about £4 now?
You know, I think coffees are cheaper in Spain because of what the government's done. So I think, you know, the private sector...
He won that one. He won that one.
And households are benefiting.
Okay.
So it might be the right thing to do for business as well.
OK, Carsten, fascinating to talk to you. Really appreciate your input. Carsten Jung, former Bank of England economist. I know you want to come in, Candice Holdsworth, joining us all this morning.